Gold prices have crashed. Gold prices have crashed. Since 2011, gold has plummeted more than 25%, and the worst may not yet be over. The Profit Strategy newsletter at ETFguide.com warned its subscribers the gold bubble would pop, and it has. Our gold alert given to subscribers in early 2013 resulted in a 500% gain. What happens next in the gold market will shock the entire globe. Join today at ETFguide.com and get a $50 bonus by using promo code SAVE50.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Welcome to the show. Coming up on today's broadcast, is a government closure bad for stocks? Also coming up, how to avoid a $30 million mistake. We're going to share with you how one famous actor made a $30 million mistake, and I want to explain to you how this could have easily been avoided, how you can avoid a similar mistake. Also, a recap of third quarter performance for my ETF weekly picks. As all of you know, I publish a monthly newsletter. We also do weekly picks, and I want to give you a recap on how we've been doing so far. Now, we're in the final stretch of 2013. Take a look at your investment portfolio. How is it performed versus major stock and bond benchmarks? This is gut check time, folks. I mean, this is really it. If your portfolio, if your investments, your IRA, your 401k plan, your brokerage account, your family trust account has not been able to keep up with or outperform major stock and bond indexes and the ETFs tracking them, well, I'm sorry to say you're on the wrong track. It's time to regroup. It's time to refurbish, remodel your investment portfolio, get your mind right so you can get your money right. That's really the benchmark of performance, is how you are doing versus major benchmarks. And really, the easiest way to avoid massive underperformance, the easiest way to avoid falling behind is to make your portfolio, build it on a solid foundation of low-cost index funds and index ETFs. That way, you never have to worry about significantly underperforming. And by the way, that strategy right there alone will help you to beat 80 to 90% of Wall Street's overrated money managers. If you'd like to join us today to talk about a particular stock, mutual fund, ETF, or investment theme, you want to weigh in on the government closure and the upcoming debt limit debate, which, as I've told you before, is nothing more than a giant dog and pony show, because we've already gone $39 billion over the debt limit. Yep. If we have time, I'll explain that to you. 877-711-5611. That is the number. Give us your first name along with your city and a ticker symbol. You can also tweet us. At Index Show is my Twitter handle. Again, that's at Index Show. And you can also email me, ron@indexshow.com. So, by the way, I want to mention real quick here, we've got Andy O'Rourke of Direction Funds coming up, and we will be talking about a thing that they've got coming up on October 7th. It's an ETF trading challenge. So we want to see how good you are, or maybe how bad you are, when it comes to picking a specific ETFs. And it's going to be a fun game. And so he's going to explain to us some of the details of the ETF trading challenge. So stay tuned for that. So taking a look at major market performance, well, the stock market wasn't too freaked out, was it, by the closure of the U.S. government, or as they're calling it, a shutdown. And if you look at history, history really shows that stock market isn't bothered by government shutdowns. I mean, really, if we take a look at the last shutdown from 1995 to 1996, there were two. You had in late 1995, November 14th to November 19th, that 5-day period, the S&P 500 actually gained 1.3%. And then a few weeks later, there was another shutdown. That began on December 16th of 1995 and ended on January 6th, 1996. And what happened to stocks? Well, the S&P 500 recorded a small gain of 5 basis points. And so if we look at not just the performance during the shutdown, but thereafter, 6 months after the first shutdown, the S&P 500, as tracked by the SPDR ETF, SPY, was ahead by over 14.5%. And then after the second shutdown, the S&P 500 was up 9.5%. So this time around, we saw pretty much a repeat performance of U.S. stocks, which have been gainers and continue to be gainers this year. Now, we don't look at 1 week's performance because it doesn't really give us that much perspective. I like to give you a little bit of a bigger picture. That's why I like to refer to the year-to-date numbers. And if we take a look at the total U.S. stock market, was still ahead by just over 20% since the beginning of the year. And that's per the Vanguard Total Stock Market ETF. That's ticker symbol VTI. So we continue to do pretty good there. At the same time, we continue to see even better performance out of specific industry sectors like healthcare, XLV, which has gained just over 28% and is easily outperforming the S&P 500. That biotech sector has just been really, really boosting the performance of healthcare stocks. So that continues to be one of those sectors that is not just leading the S&P 500 higher, but continues to perform its peers within the S&P 500. Another sector that continues to do very well has been the industrial sector. Some of those companies like Caterpillar and Deere. XLI is the ticker symbol, ahead by a nudge over 22%. So how is your portfolio doing? Have you been able to keep up? Are you profiting from the trends that are at hand? 877-711-5611 is the number. We're here. Join us. Now, taking a look at our third quarter performance at etfguide.com, we do a weekly pick, and we pick really ETFs that we think have a good chance, high probability of making money. And some of those gains, well, we're not trying to hit home runs. We're not trying to hit grand slams. Sometimes we do, but we're really aiming to get walks and singles. And if we can get enough walks and singles, well, the doubles, the triples, the home runs, and the grand slams will hopefully come. Now, during the third quarter, we rang in more profits from this year's biggest investment theme, which is the great gold crash of 2013. We were right in the thick of it, people. We had short trades on gold mining stocks. That was on July 31st and also September 18th, ticker symbol DUST. We also had a short trade on gold itself. That was from September 5th on ticker symbol GLL. We also capitalized on a brief fall in long-term U.S. Treasuries. Ticker symbol TBT is the ETF that capitalized on that trade. And we also had a brief fall in emerging market stocks. And we also recorded a small gain from our long position in the solar stock ETF, ticker symbol TAN. So what was our largest ETF gainer for the third quarter? Well, it was our 731 alert to buy the Direction Gold Miner Bear 3X shares, ticker symbol DUST, that resulted in a 1 week blended gain of 23.5%. It was a great trade. Now, on the options side, we also had a tandem trade to buy some put options on GDX with an October expiration. That was a pretty good trade, resulted in a 2-day 68% profit. And so these were some outstanding moves. In total, since the beginning of the year, 74% of our weekly ETF picks have resulted in gains. And our biggest winner was actually earlier in the year. It was a 525% grand slam. That was also a short, by the way, on gold mining stocks. And but at any rate, you've got the numbers there. That's a pretty good batting average, 74% winning percentage. And if you want to follow along with our upcoming trades and moves, just go to etfguide.com, click on the Profit Strategy newsletter. This is the Index Investing Show. I'm Ron DeLegge. I'll be right back.
The Index Investing Show with Ron DeLegge.
Okay. 877-711-5611. If you want to talk about a particular stock, mutual fund, ETF, if you want to talk about the government shutdown, you want to talk about the giant dog and pony show coming up with the debt limit debate, and really it's not much of a debate because if you look at the U.S. Treasury and its own daily reports, which I look at, you'll see that we're currently, and we have been over the past several months, $39 billion over the legal debt limit. Can you believe this? I mean, how asinine, how hideous, how offensive is that? So they're having a debt limit debate, and we're already over the legal debt limit, according to the U.S. Treasury's latest report. And all you got to do is see the accounting tricks and the creative accounting that they're using at the U.S. Treasury. They've taken all these line items, and they've simply labeled them as not subject to the debt limit. Statutory debt limit. Can you believe that? So that's basically like taking some of your bills, right? If we applied these same principles to your personal finance, you accountants out there, if you took your clients' liabilities and you just labeled them as, oh, well, these aren't really liabilities, these are assets. Can you imagine practicing that type of accounting? Would that get you fired? Would that get you put in jail if you're a corporate executive, if you're a CFO? Yet the U.S. Treasury is practicing the same kind of nonsense with their accounting. So really, it's a giant dog and pony show, even if they do raise the debt limit, which, as I've told you before, don't bet against history. The odds are that they will. Congress, since 1960, has done it 79 separate times. They've either altered the definition of the debt limit, they've suspended the debt limit, they've raised the debt limit. This is what Congress knows. They know no other way. Now, they're going to have a lot of rhetoric leading up to that. They're going to wait to the last minute, as they always do. But the debt limit will be raised. It will be raised. There won't be a default. But getting back to this government shutdown, we explained to you that really not a bad thing at all for the stock market. What about other asset classes outside of stocks? What about the dollar? What about gold? What about treasuries? Well, the average performance of these various assets during government shutdown periods, we'll just look at the 10 days after the shutdown. This is from 1983 to present. This was combined, the data was combined courtesy of Bloomberg and Guggenheim Investments. And the U.S. dollar, 10 days after the shutdown, this is from 1983 to present, all the shutdowns since that moment or that period, the U.S. dollar has gained 1.2% 10 days after the shutdown. Gold has fallen 1.3%. That's a historical return. And then, of course, another historical return is commodities, which have also fallen at 2.9% at 10 days after the shutdown. And then also taking a hit, 10-year yield on U.S. Treasuries falling by 22.5 basis points, which is almost 0.25%. So there you kind of have a recap, a historical look at the performance of all these asset classes 10 days after a government shutdown. So will history repeat itself? Well, we will see. So far it is. Because stocks have been gaining during this government shutdown period. 877-711-5611 is the number. You're listening to the Index Investing Show. We're here if you want to talk about a particular stock, mutual fund, ETF. If you want to get a portfolio report card, tweet me at Index Show. You can also email the program, ron@indexshow.com. Also, if you're just joining us, we gave you a quick recap of what our weekly pick performance has been at etfguide.com. As you know, I'm the publisher and editor of the ETF Profit Strategy newsletter at etfguide.com. And since the beginning of the year, I'm proud to say 74% of our weekly ETF picks have resulted in gains. And that's not easy to do. What we try to do, we're not trying to give our readers the most ETF trades, but rather just the ones with the highest probability of success. And so that means that even when we get a small capital gain, we're happy, we're content to take that because it adds up. We're after victories. And if we can make those victories or those wins pile up, that's what we're trying to do. We're trying to win the game. And also, along with that, we're trying to minimize our losses. So while we ride our winners, we always try to minimize our losses. We have something that goes against us. We always have a stop loss. We don't second guess that stop loss. We don't double down. We don't triple down on losing trades or losing investments. We get out and we focus on what's working. Now, I want to help you to avoid a $30 million mistake, because that's what happened to Sopranos star James Gandolfini's heirs. This is a $30 million mistake that he made. So federal and state tax collectors will take more than $30 million of Gandolfini's estimated $70 million estate. Can you believe this? That's according to published reports. Gandolfini, who starred in the acclaimed HBO series The Sopranos from 1999 to 2007, died of a heart attack while vacationing in June at age 51. Estate attorney William Zabel, who reviewed Gandolfini's will, he did that for the New York Daily News, called it a disaster. I'd say so. I'd say nuclear bombing your estate by more than $30 million because you didn't do some planning. Yeah, I would say that it's a disaster. Wealthy individuals and families looking to protect their estates from heavy tax burden should do so now. And Gandolfini's example is a perfect one for how not to plan for your estate. This is really, really very important. Well, really not just for those of you with a large estate, but all of us. All of us really need to be doing a better job. You know, in case you didn't get the memo, there's 3 ifs in life. And the prudent person plans for all 3 ifs. If you live, if you die, and if you become disabled. Those are the 3 ifs. Now, for the purpose of this program, we assume you're going to live. We assume you eat your salad at least once a week and don't cross the street without looking both ways. See, we assume that. But even so, life has a way of really surprising us. And so the time to take care of your estate planning, people, is not when you're dead, but when you're alive. Because, well, being dead is a full-time job. And once you're dead, you don't have time for anything else because, well, you're dead. It's a full-time job. So the time to do your estate planning is right now. And that means having a proper will. It means having your life insurance properly structured. Generally, I recommend revocable life insurance trusts to own your life insurance policies in, so that doesn't increase your estate, the value of your estate needlessly. So this is the time to take care of these things. This is not an estate planning focused program, but I think it's important for us to mention, because when people like James Gandolfini and his estate and his heirs are going to lose $30 million because of a few simple signatures that could have been signed on some documents, well, that's just the sort of mistake that we shouldn't be making. And especially those of you that listen to our San Francisco show that are venture capital types or these young types in Silicon Valley that are aiming to change the world. Well, don't forget you're not free from these things either. You know, you have to take care of these things because anything can happen. Death has no favorites. It takes the young and the old alike. So plan now and make sure that you do it right. You're listening to the Index Investing Show I'm your host, Ron DeLegge, 877-711-5611. Coming up next, we're going to talk about the ETF Trading Challenge with Andy O'Rourke.
The Index Investing Show with Ron DeLegge.
Have you met Jane Investor? She wants her investments to grow, but she's too busy to bother. In fact, Jane Investor is so busy she didn't realize owning real estate investments in the wrong brokerage account exposed her to unnecessary taxes. She also forgot to roll over her 401k plan because, well, she was too busy. The Profit Strategy newsletter at etfguide.com helps busy people like Jane Investor to stay on top of their investment portfolios. We tell you what to buy, what to sell, and when to do it. It's okay to be busy, but it's not okay to be sloppy with your investments. The Profit Strategy newsletter at etfguide.com will save you time and help you to succeed. Join today and get a $50 bonus by using promo code JANE50. Our monthly newsletter, our weekly picks, and our technical forecast will keep you ahead of the pack. Go to etfguide.com to get started and promise yourself to never, ever be too busy to be properly invested.
Well, Direction manages a lineup of 50 ETFs, long, short, and everything in between. $6.8 billion in assets, and we're pleased to be joined by Andy O'Rourke at Direction. Again, the URL, directionfunds.com. Andy, welcome to the Index Investing Show. Great to have you with us.
Thanks, Ron. It's really great to be here.
So I want to talk a little bit about this ETF Trading Challenge, which kicks off on October 7th. Tell me about the game. It sounds like a lot of fun.
Yeah, we're really excited about it. We think it's going to be a lot of fun. I think it born out of the idea that when we think about our products, we think about how they are, the leverage and inverse products particularly. They're real speedy athletic products, we like to refer to them as, and we think the people who use them are, think that way and kind of have a competitive edge to them, and we just thought naturally it was a great idea to put together a contest. We're excited to put it together along with the Street and Stock Picker, and we'll serve as the sponsor for the event. And registration is open now, and the contest is going to kick off on Monday, October 7th, this coming Monday, and run for 10 weeks through December 13th.
So how does the ETF Trading Challenge work? Everybody gets $100 of play money, and whoever makes the most at the end of each week wins. Is that pretty much how it works?
Yeah, actually, we're feeling super generous. So actually, it's $100,000. But as you say, it's only to be used within the context of the game, unfortunately. But fortunately, because it'll be fun to do, I think. And we are allowing people to trade that money however they like, but it does have an ETF theme to it. And we're going to be offering prizes for the top 3 finishers in the overall tournament for the entire duration. But additionally, we're also offering weekly prizes for the people who have the best performance for each of the 10 weeks throughout the contest.
Excellent. And so players get what's called bonus bucks for trading ETFs and especially direction ETFs. Is that right?
Right. Yeah. Like I mentioned, players can trade whatever they want as long as it's trading on a major exchange. But we are applying an ETF theme to it. So we're offering what we're calling bonus bucks. So if you decide to trade any ETF, we're going to offer you 10 basis points as a proportion of the position amount for each of those trades in an ETF. But then as the sponsor, we're also going to add incentive there, and people who trade direction shares ETFs will be given either 20 or 30 basis points of bonus bucks, depending on the particular direction share that they choose to trade.
If you're just joining us, you're listening to the Index Investing Show. Pleased to be talking with Andy O'Rourke at Direction Funds. Directionfunds.com is the website, and they've got a ETF Trading Challenge, which kicks off on October 7th. Now, when you look at Direction Funds' menu of both mutual funds and ETFs, not only is it really a unique lineup, but it's designed for both bulls and bears and anybody in between. And I think it's a very different approach from how most fund companies operate. Talk about that.
Yeah, I guess I try to look at it kind of simply, and I sort of look at there are two types of people in the world: those that make their own decisions, have their own perspectives on the market, and those that are looking to defer those decisions to someone or something else, like a mutual fund, for example. In the case of the former, that's what our leverage and inverse ETFs are really geared towards. It's people who have their own perspective on the market. They believe a given asset class or sector is either going to be trending positively or negatively, and so we provide them with the tools to either magnify that position with our leveraged 3x products in a bull direction, or if they're bearish on a given sector, that we can actually allow them to trade in that direction with the bear funds.
Now, what's the goal of the ETF Trading Challenge? I mean, other than having some fun and getting some kicks, you obviously want to educate people about ETFs and especially how those inverse and leverage funds work. Talk about that.
Yeah, exactly. We just think it's a great forum for people to hone their strategies within trading ETFs particularly, or perhaps they've dabbled a little bit with the leverage and inverse products, but they want to try to hone those skills a little bit differently because they do behave in some instances a little bit differently than a traditional non-leveraged ETF. So it's a perfect opportunity for them to trade with those particular types of products without actually having exposure to true market risk. But first and foremost, we think it's going to be a lot of fun, and that's the real driver for it.
Now, one of the most volatile industry sectors this year has been gold miners, and you've got the long and the short gold miner bear and bull 3X shares, ticker symbol NUGT for the bull, and then for the bear, ticker symbol DUST. Now, you just came out with some gold miner junior ETFs that do basically the same thing, leverage up, leverage down. Tell us more.
Yeah, exactly. In fact, you mentioned at the beginning of our conversation that we offer 50 funds. The number is actually up to 52. With the addition just yesterday, began trading on the junior gold miners bull, which is JNGT, as well as the junior gold miners bear fund. And again, these are 3-time leveraged funds, and that's JDST. And just giving people an opportunity to get into the gold. There's actually a little bit of exposure to some mining companies as well, but these are smaller cap companies within that particular sector.
And those smaller caps tend to be more volatile too compared to their larger cap counterparts, but nevertheless, for those that want to play the precious metals theme, either bullish or bearish, check out those two ticker symbols again, JGNUT and then JDST. If you're just joining us, you're listening to the Index Investing Show. Pleased to be talking with Andy O'Rourke, DirectionFunds.com, and we've been talking about the ETF Trading Challenge, which kicks off on October 7th. And that, just to check with you, that's going to run for 10 weeks. Is that right?
That's right. Yeah, you got it. So, again, it starts on Monday, October 7th. Let me let people know where they can go to learn more about it and to register. The URL for that is stockgame.stockpicker.com. That's stockpicker without an E, STOCKPICKR.com, and you'll be able to register there. Everyone who registers will also be invited to participate in a kickoff webinar that we're going to be hosting on Monday in the afternoon Eastern Time, 1 o'clock. And sort of we look forward to everyone to join that, sort of a little pep rally as we get the game going.
That sounds great, and thanks for giving us the heads up. We're going to send out some tweets and Facebook and all that other stuff to those links, and we will check back with you. And we're looking forward to finding out who the real good traders are, who the winners of this contest are going to be. Like I said, it should be fun.
Yeah, we're looking forward to the same.
Again, that was Andy O'Rourke at DirectionFunds.com. This is the Index Investing Show. And I'd like to give just a quick correction to those ticker symbols on those new Direction Daily Junior Gold Miner ETFs. Ticker symbol JNUG, that's N like Nancy. JNUG is the Direction Daily Junior Gold Miners Bull 3X shares. So that aims for triple daily leverage to small cap gold mining stocks. And then the opposite of that is the Bear 3X shares, ticker symbol JDST. And those are both new direction ETFs. And this continues to be a sector that is going to come under more pressure, in my view. And we've been right about this particular trend. Gold miners as a group down more than 35% year to date. And this has been one of the few places within financial markets where it's been safe to short in an aggressive manner. Ticker symbol DUST, which is the direction daily gold miners Bear shares 3X on a year-to-date basis, up an amazing 137%. So that continues to be a very good trade for you bears. You're listening to the Index Investing Show. I'm Ron DeLegge. We're here, 877-711-5611. At Index Show is my Twitter handle. If you want to talk about a particular stock, mutual fund, ETF, I'm game. I'll be right back.
The Index Investing Show with Ron DeLegge.
All right, we got a post on our Facebook account from Robert, longtime listener. He asks, what ETF or mutual fund is a good play on the Affordable Care Act? Do you think any speculation is already reflected here in the price? Well, the healthcare sector has really been one of the best performing industry sectors within the S&P 500 all year long, and it continues to be. Ticker symbol XLV is the ETF that follows those healthcare stocks like Pfizer and Johnson & Johnson and Amgen and all those other companies. Now, this particular sector, I don't think, if you want to invest in the healthcare sector, Robert, I think definitely XLV is the best pure play. But the main thing here is with or without the Affordable Care Act, healthcare is really a good play. Demographics matter. We've got an aging population. That's going to keep this sector going. And regardless of what type of legislation, we're always going to see changes. I don't really think that's something that should be a main factor in driving your investment decision, whether to invest in healthcare or not. So I don't think really this is something that's a quick trade or a good play to be making. I don't think that's the correct view. I think you want to own healthcare stocks in the healthcare sector. It's not a trade. It's more of a buy and hold type of investment. And when I say buy and hold, I don't mean buy and forget, but something that I think you can hold for a number of years as this trend begins to get even more firmly rooted. I mean, wasn't it in 2011, just 2 years ago, that the first of the eldest baby boomers began to turn age 65? And now that continues for the next 10, 20 years. And so the healthcare sector is definitely going to be a beneficiary of that. 877-711-5611 is the number. You're listening to the Index Investing Show. I'm your host, Ron DeLegge. We're here. Now, if you ever miss our regular radio broadcast for whatever reason, you can pick up our free podcast. It's available at iTunes. Just search under the Index Investing Show. We also publish our broadcast via YouTube. So if you don't have iTunes or you can't listen there, you can go to YouTube and listen to our archived programs and enjoy the show that way. Now, let's talk about the debt limit debate or ceiling. The federal debt limit, just to do some 101 and explain what this is. It was originally intended to free up Congress from having to authorize each instance of new borrowing by the U.S. Treasury Department. So if the debt level reached a certain limit, the Treasury, what happens, they can only pay out as much as they're taking in each day. And that's far short of the amount needed to cover spending that's been already approved by Congress. So setting an aggregate limit gives the Treasury more flexibility in issuing debt instruments, treasuries, that allow the government to cover its obligations. So at various times, the threat of default has been used by both political parties as a bargaining chip in attempts to win concessions on other issues. And this is exactly what's happening right now. Now, the current debt limit, which was set temporarily in May at $16.7 trillion, and that was that was on May 19th. And so the U.S. Treasury Department has issued this warning saying, well, if the debt limit's not raised by October 17th, it is out of time. It's extraordinary measures that it's been using since May have been exhausted. And of course, those extraordinary measures include creative accounting and accounting tricks, putting liabilities in listing them as assets, or saying that they don't count against the debt limit. I mean, it's ridiculous. It's ridiculous. It's the kind of accounting that if anybody in corporate America practiced, they'd automatically go to jail, pretty much. Yet the U.S. Treasury is practicing this type of nonsensical financial accounting. So the point here is, you ask, well, is it time to short U.S. Treasuries? Is it time to bail? Well, we're going to see, and this has been a trend that's taken a while to unfold. We've already seen more than a 50% increase in yields on the 10-year U.S. Treasury. Lest I remind you, that's been over the past year, by the way, lest I remind you, this has been at the same time that the Federal Reserve has been buying up long-term U.S. Treasuries in an attempt to depress artificially interest rates. And so even with the Fed buying up all of these treasuries in an attempt to keep down yields or keep down interest rates, it's only worked up to a certain extent. It hasn't been able to prevent the Treasury market, the yields, from rising more than 50% over the past year. That's a big move. Now, rates historically are still relatively low. But my point here is we're going to get to a point where the market doesn't believe what's coming out of the U.S. Treasury Department. Now, I don't believe what's coming out of the U.S. Treasury Department, okay? Just between you and me, I don't believe the nonsense coming out of their mouth. I know that for a fact that they consistently fudge the numbers. They consistently use fuzzy math. They consistently understate the level of true debt in this nation. And so the point here is that at some point the market is going to begin to question the U.S. Treasury and its ability to pay back all of this debt. And then what's going to happen after that is it's going to be creditors that have those same questions and say, do we really want to be lending our money to the U.S. government anymore? And furthermore, do we want to be lending our money to the U.S. government at these types of interest rates? Well, if we're going to lend them money, and we know they're a bunch of drunk spending drunkards, we're going to charge them higher interest rates. We'll lend them money, but they're going to have to pay us a higher rate of return because of the higher risk associated with giving them more money. So when you have that breakdown in confidence, and it happens to all financial markets at some point, where there's a total lack of confidence, whether it's stocks, whether it's gold, whether it's real estate, whether it's treasuries, the point is you don't want to be left holding the bag. And that will be the time that you'll need to be prepared for. That will be the time when it'll be the signal that you should totally be out of treasuries, or you should be short that particular market. And there's several instruments on the ETF side that will allow you to profit from that. Ticker symbol TMV and TBT are two such ETFs. Don't currently have any positions in those in the ETF Profit Strategy newsletter. We did briefly earlier this year, and we are glad to say they were profitable trades. But this is a big, big investment theme that is in the midst of unfolding, and it's best to be ready for it and to be prepared. 877-711-5611 is the number. You're listening to the Index Investing Show. I'm your host, Ron DeLegge. Like I said, if you ever miss our regular radio broadcast, you can pick up our podcast. It's available at iTunes.com. You can also pick up our show via YouTube. And if you're just joining us, we talked about a number of things. We talked about the final stretch of 2013. Take a look at your investment portfolio. We're in the fourth quarter. Reassess your holdings, people. Take a look at your stocks. Take a look at your bonds. Take a look at your mutual funds, your ETFs. How has your aggregate performance really been doing? On last week's show, we gave a portfolio report card for a listener in Dallas. He got a C, which is not a very good grade. And I will look at your investment portfolio in 5 key categories. I'll look at cost, diversification, risk, tax efficiency, and then performance. And after I dissect your portfolio, in each of those 5 categories, I'll give you a final grade of an A, B, C, D, or F. It's time to find out how you're doing, and I will tell you. Well, that just about does it for another episode of the Index Investing Show. You can read my daily articles at etfguide.com. We'll be here again next week, same time, same station. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.